Is another webinar of our series about Japanese candlestick trading strategies. I'm so happy to have you all here. My name is Ali. I'm the VP of Market Analysis and Education at Inveslo, and today we are going to talk about the most common and well-known candlestick reversal patterns as bullish and bearish reversal patterns. Please be aware that all the information that we are providing during our webinars are just for educational purposes, and please don't take them as the investment or trading advice. Thank you so much. And also during this session, I switched off my camera to give you a better revealing of the presentation. Thank you so much. And like always, we always mention that the education is the most important part of your trading journey, because if you want to become a successful trader, it's very necessary to learn and leverage your knowledge. That would be better to put understand actually the market structure and be familiar with all the concepts behind the and functions behind the market fluctuations before putting your money at risk. So trading doesn't have anything to do with the chance or luck, and everyone can learn to successfully trade with the right tools and guidance, but it's very important to take it serious, because when you see the trading financial market as a serious business, it means you need to make some consistent researches every time and all the time, and it's much more important actually aspect of a trading journey than the trading itself. Okay, I hope we can provide you a good understanding and help you during your trading journey. Let's start with the agenda. Today, we will talk about the common bullish candlestick patterns and bearish candlestick patterns, and then we will review a way. There are a lot of ways you can trade the Japanese candlesticks, but I would prefer just come with one simple strategy to make the most of these candlestick reversal patterns. As we discussed before, the candlesticks are a very useful tools to reveal the market psychology, and we can measure the sentiment and volatility of the market at the same time by having four prices. Excuse me, let me just turn on my laser point and let me have just make some changes. Thank you. Okay, here you see on my presentation, we need four prices to shape a candlestick. Open price and close price are limited, are limited. The body of the candlestick is a rectangle here that can be bullish or bearish, and also we have the high price and the low price of the session. We can determine the sentiment of the market by measuring the length of the body, and also we can measure the volatility of the market by considering the length of the shadows. Usually shadows mean the rejection of higher or lower prices, and also the body shows which side of the market has the upper hand. In that regard, we can have two bullish and bearish types candlesticks. That when you see the close price is higher than the open price, it means we have a bullish candlestick, and vice versa. When you see the close price, the market actually, for example, has closed below the open price, it means we have a bearish session and we consider it as a bearish candlestick. They usually come with different colors on the different charts, but it doesn't matter, because every time you look at the chart, you can understand which one represents the hollow body, or the bullish one, and which one represents the fill body. It can be the blue and red, or a green and red, or some other colors. That doesn't matter. But the important is that we have to consider the close price and the open price to determine the market sentiment. We discussed it in our previous webinars as the candlestick chart explained. But let's go further and take a look at some common bullish candlestick patterns. Okay, long bullish body. Actually, we use candlestick charts to see what is going on with trend. For example, first of all, we want to find out a direction of the trend, and also we need to measure the strength of the trend or the momentum, and we are using these candlestick patterns to determine if the trend is keeping running or no, it's going to reverse somehow. One of the famous candlestick patterns is a long bullish body. We call it Marabuzu. You know, the Mr. Nason in 1970s actually translated a lot of articles and patents from Japanese to English for the first time, and provided us with the knowledge about the Japanese candlestick charts, because it wasn't that famous in the Western charting methods, because this is kind of in the Asian charting methods. And then Mr. Nason translated all of those structures and explanations and all of those knowledge about these candlesticks. And now one of the most important one is the long bullish body. The long bullish body, as you see here, is a candlestick with a long white body or a bullish body that forms at the end of a downtrend. It's very important because it usually appears at the end of a downtrend, and it's a bullish reversal implication. That means the prolonged decline brought prices lower, as you can see, for example, here in the duration of a downtrend, and to a point that caught the traders' attention somehow, who then entered the market aggressively at the beginning of the session, pushing prices higher, and the closing price is greater than the opening price. It means buyers somehow entered the market and managed to keep prices moving up. They found these levels very interesting. It means the sentiment of the market is changing to bullish. Okay, so this long body suggests that buyers are fully in control, or demand is greater than supply. We consider it as a very, very bullish candlestick, especially at the end of a downtrend. The way that we can trade these candlesticks is that usually the next candlestick can confirm the persistence of the bullish sentiment in the market by exceeding or over the high of this bullish candlestick formed in the previous session. Okay, it means we can buy if the candle exceeds high of the long white body at this level, and then we can put our stop loss here. And to manage our take profit levels, we can choose to have a 1-to-1 reward to risk ratio or 1-to-2 reward to risk ratio. It depends on your risk management rules. After that, we have another stronger bullish reversal pattern. We call it the bullish engulfing, guys. A bullish engulfing pattern consists of two candles. You see, the first one is the black one or the bearish one, and then we have this bullish candles follows a short bearish body. And the body, the important part is that the body covers or engulfs the previous candle's body. Please pay attention that the shadows are not important here. We just look at the body of the candle. When you see the long or bullish candlestick during a downtrend appears after a bearish candlestick and covers all the previous body, it means we have an engulfing bullish pattern. And the way that we can trade it is we can consider buying if next candle the third one actually, exceeds the high of the long white body here, and then that would trigger a bullish signal for us. We can enter the market or open a buy position and put our stop loss usually at the lower price of each of these candles, maybe this one or this one. It is better to put your stop loss as low as possible when you see the market has reached already some points lower. But by the way, after putting your stop loss, you can manage your profit target, very usual, by considering a 1-to-1 risk ratio levels. The psychology behind the engulfing pattern is that during the course of a downtrend or downward move, and while prices fall lower, the presence of a smaller black body signifies a short second thoughts on maintaining the bearish direction. It means we see here that the bearish sentiment of the market is waning. So after that, while the bears show signs of weakness, the bulls just enter the market aggressively as they are lured by the attractiveness of prices. You see at the opening of the engulfing session, we see the prices are opened at the lower level from the previous close. Okay, see, somehow or for some reasons that we don't know, buyers found this level very attractive, and then they jump on the market aggressively and push all the prices higher and close above the previous open. It means they could cover all the losses from the previous session, and this is a very bullish signal for us when we see this engulfing pattern. So this is the actually market action or market psychology behind the engulfing patterns, which is a very strong actually pattern. Sometimes we see changing or turning of market sentiment is not as strong as engulfing patterns. It means we have a bullish candlestick follows a bearish candle, like here, and the body exceeds only the middle of bearish candle, and it can't cover whole the previous body. It means after jumping, buyers after jumping on the market push prices higher, but they didn't have actually that strength to push market higher to cover the whole losses of the previous session. So it means the body exceeds the midpoint of bearish candles body. So if we consider this line at the middle of the previous body, we need to make sure that the bulls has been strong enough to push the prices above the midpoint of the previous one. So it means sellers are losing control while the buyers trying to take control, but they are not in a full charge of the market. Okay, it means traders open short positions in the direction of the descent as it remains intact. You see, this is a downtrend, and please take note of this, that all these bullish reversal patterns should appear at the end of a downward movement. For some reasons, actually, bulls find prices attractive at this level, entering the market aggressively with long position. The session closes with gains for the bulls, who managed to close the long white candle here, well into the previous candle body. It is into the previous candles body. It means the demand is still greater than supply, but to trade these kinds of patterns, we need to consider buying if the next candlestick here, the third one, as a confirmation, exceeds the high of the long black candle or high of the, the open of the whole pattern. It means we can consider opening a buy position at the level that the price just crosses above the open of this bearish candlestick here. But somehow, if you are a more let's say conservative trader, you can find your entry point at this level after crossing above this high, the high of the whole, let's say, pattern, maybe here. And some aggressive traders usually trade by overstepping this level. It means the close price of the piercing line here. Some aggressive traders, but it depends on you, and then you can manage your take profit levels by choosing the 1-to-1 reward to risk ratio. And piercing pattern means sellers are losing control and buyers are trying to get back to the market. It is not as strong as engulfing patterns. And after that, we have another pattern as a bullish harami. Bullish harami is a very tricky pattern, guy. This is a small candlestick body of either color, doesn't matter. It could be white or black. Follows a long bearish candle, as you see here, and the body is contained by bearish candles body. It means when sellers lost the control or lost the momentum, so there is no interest in lower prices here. That caused the market to open at this level higher than the previous close. Okay, and then but at the same time, buyers don't see enough attraction in the prices to take the whole control and cover or exceed the previous open. It means we have some fluctuations contained by bearish candles body by previous trading session. It means we have a less fluctuations compared to the previous session, and this is kind of an indirectional candle here, and it suggests a phase of uncertainty. When it appears at the end of a downtrend, or means during a downtrend, we can consider that the downtrend is out of steam. The way that we can buy it, we can actually consider to open a buy position if we see the third candle as a confirmation candle comes above open of the pattern. It means at this session, this long black candlestick here, and then we can open a buy position, put our stop loss at the low of the pattern, and then we can manage and take profits in the same way by 1-to-1 risk reward ratio, or maybe using another tools like Fibonacci extension or something like that. But depends on the place that these patterns appear on the chart. You can manage your risk to reward ratios and you can manage your take profits, because it's very important when they come after a very significant movement in the market. We can expect actually more aggressive reversal there, so we can put our take profits higher maybe, and we can take a less risk there in the trade. But sometimes when they come after some range or they appear at the boundary of the range markets or somewhere like that, I will show you on the chart later, and then we will consider to take a more risk on trading with these candlestick patterns. Okay, let's go forward and take a look at the hammer. The hammer is one of the single candlestick patterns, and also there are many more candlestick patterns, but you can find them on a book of Mr. Nason. The name of the book is the Beyond Candlestick Chart Patterns, and also Candlestick Charts Explained, if I don't get it wrong. Yeah, I guess something, and you can search it and you can find it. It's a very informative book about the candlesticks, the trading strategies, and everything that you need to know if you want to have a deep research on these psychological tools actually. Okay, let's continue with the hammer candlestick, single candlestick pattern. The hammer candlestick has a shape like this, with a small body and a very long lower shadow that is 2 or 3 times longer the size of the body. Actually, the presence of a hammer at the end of a downtrend or decline alerts for a possible bullish reversal and traders enter the market with short positions. This is the psychology behind the formation of the hammer. When you see the sellers that just continue to push prices lower in the direction of the prevailing trend, because this is a downward movement or downtrend, to form a lower shadow. That's why we have this lower shadow, because the sellers already push prices lower to this level, for example. Eventually, the downward move is proven short-lived. Why? Because bulls took control and managed to close the session at the upper area. It doesn't matter, the color of the body actually doesn't matter. It can be white or black, no problem. But the important thing is that we see the dynamic sentiment of the market is changing during this session that formed this hammer candlestick here. It means after sellers push prices lower to this level for some reason that we don't know, buyers just jump on the market and didn't let them to continue the downward move, and that's why they formed this long lower shadow here. And the length of this lower shadow, as you see here, is 2 or 3 times longer than the size of the body. It appears at the end of a downtrend. It means buyers overcome sellers. You know, each session is a battlefront between the buyers and sellers, and depends on which side overcomes the market. We can determine the sentiment of the market by measuring the size of the body and the size of the shadows. So as we explained in our previous webinars, you know, you can understand all the psychology behind these candlestick patterns by just looking at the shadows and bodies. The way that we can trade is, as usual, we can wait for the second candlestick to exceed the high of the hammer, and then we can open a buy position, and then we need to put our stop loss at the low of the hammer. Very good. So this is about the bullish candlestick patterns, guys. Please give me some feedback if it was almost clear to you, and please let me know if you have any questions regarding this bullish candlestick patterns. So are we cool? Okay, shall continue. Let's start the bearish candlestick patterns with the long black body, which is a long bearish candlestick with a very short or no shadows, appears at the end of an uptrend, and it means the sellers are fully in control. We can trade it just by considering opening a sell position when the prices get below the low of the Marabuzu. This is a long black body, and it represents that market is fully in control by sellers. The next one is a bearish engulfing pattern, and the bearish engulfing pattern is the one which we consider it as a more stronger bearish pattern, because we have a bearish candlestick usually with a long black body follows a short bullish body or the short white body, and the body of this long bearish candle covers the previous candle's body. It means or engulfs. It means at the end of an uptrend, we see the sellers during the course of an uptrend move, and when the prices actually rally higher, the presence of a smaller white body signifies that longs have second thoughts on maintaining the bullish direction, because they form this let's say the short body candlestick here. While the bulls show signs of weakness, the bears enter the market aggressively as they are lured by the attractiveness of high prices, and sellers find these levels very high. As supply is higher than demand, the sentiment shifts to negative, and the sellers successfully manage to close the session below the previous open. It means they can eventually cover all the gains from the previous session. It means they are taking control of the market, and this is a reversal sign for us. We can trade it by putting our stop loss at the top of the pattern and consider to enter the market when we see the price actually crossing below the low of the pattern. It can be the low of this long bearish candlestick here, or the low of the first candle in a pattern, because sometimes these shadows are somehow very long, so it would be good to consider it, because you know, the shadows reveal the volatility of the market, and then when you see some long shadows with candlesticks coming next to each other in consecutive sessions, it means we are in a very volatile market, and it's better to take and if we want to open a trade, we need to take more risk on a trade. So in that case, we can manage to have our take profit levels maybe with a lower reward to risk ratios. For example, at the half of the length of this bearish candlestick, we can manage to close part or hold the position. And then dark cloud cover is not as strong as the bearish engulfing pattern, because as now I think you just mastered the psychology of candlesticks. You see when the sellers couldn't manage to cover the whole of the previous candle's body, and they could just lower the prices below the midpoint of this bullish candle here, and it means they don't have that strength that we expect. In that case, it's much more better to wait for the market to cross below the low of the pattern, but some aggressive traders may find this level for entry, and then we can put our stop loss at the high of the pattern, not of this candle, but here we have them all the same, and we can manage the take profit as usual, as explained. But some conservative traders just looking for crossing below the low of the pattern, maybe here, and sometimes there is some shadows along with the first candle, and then they need to consider the crossing below the low of the shadow as well. But here some aggressive traders may consider to open a position here. Also, I've seen some traders who want to jump on the market at the earliest stages, so they manage to open a sell position when they see the candle is just lowering below the midpoint of the previous one. This is a very, very aggressive position taking, and I really don't recommend it to you if you are new in trading. But I mean by all of this that there are very different ways to open the positions with candlesticks. And also we have the bearish harami. Bearish harami is a phase of uncertainty at the end of an uptrend or upward movement. It doesn't reveal, it just means we have a balance in the market. A small candlestick body of either color follows a candlestick of a long white body, as you see here as you can see here, and the body is contained by bullish candles body. It means the buyers couldn't manage to push prices higher. At the same time, the sellers don't have enough strength to put prices lower than the previous open. It means they formed only this interaction between buyers and sellers, formed the body contained by the previous one. It means we see the less volatility and the lack of sentiment in the market somehow. And to make any trading decision is better to wait and see if one side can take the control eventually, because this is a phase of uncertainty. So to trade the harami patterns, we don't look at this short bearish candle here. We just look at the pattern. Okay, we just look at the pattern. We consider the high of the pattern as a stop loss level, and we consider entering the market if we see the third candlestick confirms the reversal by crossing below the low of the pattern, or at least the low of the first long white body, means the open of the pattern. And then we can manage our take profit as explained. It means we have an equilibrium in the market and the sentiment is a neutral. We can't determine, or let's say we don't see the bullish or bearish sentiment in the market right now, because we see some kinds of balance in the market, and it's not a very strong reversal pattern. And also, the last but not least, we have this shooting star. By the way, anytime that you see a very short body candle during a series of upward or downward moves, it means the market is actually losing its momentum. Yeah, you might know you might know that from the previous webinars that we had that because this body reveals the sentiment of the market, and when it comes along in a direction of the prevailing trend, it means the trend is getting momentum, and we can expect the market continue in the prior way. But when we see it comes in a very short body, it means the sentiment in the market is fading. Or let's say, for example, here for the shooting star, we see at the end of an uptrend, the buying forces are fading. So that's caused the formation of this short body here. But also we have a 2 or 3 times longer upper shadow. Why? Because traders enter the market with long position, but eventually the seller's pressure overcomes buyer's pressure, and the candlestick closes at the lower area. Which means, for example, market was continuing in the prior way to go higher, but for some reason, sellers that jump into the market and push prices lower to this level below the midpoint of the whole session range. So this small body here and this long upper shadow reveals the weakness of the bulls, who are unable to maintain the upward movement. And after that, if we see the market comes below the low of this of the body, or the low of the lower shadow, it means we can take it as a confirmation for the as a bearish reversal, and then we can it actually triggers a sell signal for us, and then we can put our stop loss at the high of the shooting star. That's the highest point of the previous uptrend there, and then we can enter the market maybe at the low of the lower shadow or at the open price of the short black body, because usually shooting star patterns don't have a lower shadow, or they come just with a very short lower shadow. So in that case, we can choose our entry at this point or at this point, and then we can manage to close the position or take profit at the level of 1-to-1 reward risk ratio, or 1-to-2 reward risk ratio. Okay, let's look at the live chart to find some good examples about the candlesticks, and also a trading strategy that we want to discuss, which is about the reversal breakout strategy. Usually it is recommended that don't use candlestick patterns on their own. Use them always in conjunction with other technical tools like the support and resistance levels, or some indicators to measure, to get a confirmation from the other tools, because on different time frames, candlesticks usually represent different psychology of the market, and it might be confusing for many of nearby traders. For example, here we have the NZD USD on 30 minutes time frame. Let's look at the live market. The first thing that we can consider, this is a shooting star here. As you see, let me zoom in a bit. As we explained, you see it has all the components of a shooting star, this candlestick here. See, we have a very short body, and the upper shadow about 3 times of the body size. And then we see the next candle comes below the low of this shooting star here. As a simple strategy, I can use, for example, something like the RSI to confirm if the price is getting down, or I can use, for example, MACD to see if they confirm the actually prevailing bearish sentiment in the market after appearance of this reversal pattern here. For example, here you see the MACD actually confirms, because the MACD histogram is shrinking below the signal line, and that's a way that we explained in previous webinar, a way to get a confirmation from the MACD, or a way that the MACD usually triggers bearish signals when we see the histogram bars in a positive territory, and then they get below the signal line. By the way, you see, for example, here, this is the shooting star candlestick. But as a strategy, we discussed trends a lot during our webinars. We just talk about the market structure to find the higher and lower tops and bottoms. Okay, for example, here you see we have a very clear downtrend. Then when you see a clear downtrend, it means we have the confirmation from the moving average and also from the MACD or MACD, and we don't look at the RSI right now. And the price has been creating the lower tops, as you can see here, and lower bottoms. It means we have a very beautiful downtrend, and somehow we know that each top top during a downtrend or uptrend is a resistance level for us, and each bottom is a support level. And we know during a downtrend we need to see the breach below the support levels consistently. It means each bottom point should be broken by price lower, and in that case we can have a lower bottom and lower tops, and this is the definition of the downtrend. And then the very, very useful place to get signals from the candlesticks is at the formation or emerging reversal patterns during a trend. As we discussed before, if you put them together, you can see how powerful a strategy it can make for us. For example, here you see this downtrend, and then we see these support levels getting breached all the time by lower prices and making the lower tops and lower bottoms. But at this level we have this bottom, and we see the market can't break it for some reason. For some reason we see the market can't break this support area here. And after that we see this very similar to hammer. Yes guys, this candlestick here is very similar to hammer. And do you know what is do you know the name of this candlestick here? If you know, please write it to me. Okay, great. If you remember, we said the hammer is the candle with the very short body and the lower shadows 2-3 times of the short body. Okay, but here you see we have something reverse. It means we have the upper shadow 2-3 times longer than the body, and we call it the reverse hammer. Okay, this is another single candlestick pattern, and it means, by the way, it means at this resistance, at this support level here, this downward movement just lost momentum, and buyers finally found this level attractive to jump on the market. By the way, they couldn't get the full control of the market by forming this upper shadow, long upper shadow here, but also the sellers couldn't drive market lower. It means we have a very solid support area here. And getting back to the way or to the strategy of trading the candlestick patterns, we can consider buying when the price is over or cross actually over the high of this reverse hammer candlestick here, as we discussed, okay, as a bullish sign. And then you see it gives us a very, very good risk to reward ratio. It means we see a downtrend, we see a very good resistance and support area here, and we see the price can't get below this resistance, this support level. It means we can consider it as a buy opportunity if we see this reverse hammer candlestick get confirmed with the next candles, the following candles, and you see this long white body or long bullish candlestick here just breaks above the high of the reverse hammer, and it means we can consider it as a buy opportunity, and then we can have our risk taking profit levels as a 1 by 1 because it is a very strong trading setup. Okay, for example, here we can manage to get out at this level. This is the one way of trading the candlesticks at the support area. We can do the same at the resistance area in the, let's say, in the direction of the prevailing trend. If you take a look at all of these trends, so the first thing is to find the trend. Okay, always find the market direction, find the trend, and then you can find this support and resistance area. They can be the support and resistance area of the tops and the bottoms, or they can be just the trend lines. For example, if after forming this downtrend, if I connect these two tops together and continue them, I can have the downtrend line. Okay, and at some point you see I can consider it as a harami maybe candlestick, because you see after a long white body or a bullish candle here, I see this short bearish candle that can't cover whole the previous session, but after that we see the prices getting lower than the previous low, and consistently they keep it lower. It means when I have this dynamic resistance line here and I see the rejection of the price from this line, I can take it as a sell signal. It means this is the second way that I can trade the candlesticks. For sure, we need some more confirmation from the price. For example, during a downtrend, we expect the strength of sellers overcomes the buyers. Okay, so it means we have RSI readings usually below the 50 level during the strong downtrends, and then we see this rebound from the RSI here that could be another confirmation, or when we see the RSI just crossed below the neutral zone, below the 45 level that as I explained the previous webinar. So it means we can consider it as the first confirmation, and then we can look at the situation of the pattern here, this harami for example here, and also we can consider the low of the whole pattern, because you know the harami consists of the two candles, one bullish and one bearish, the long body bullish candle and the short bearish candle here. And then when you see the market actually crosses below the low of this candle and the RSI confirms it for us, it means we can consider it as a sell position. And this is the second types of strategy. In that case, you can put your stop loss at the high of the pattern somewhere like this, and you can consider to buy at this level. This is my stop loss, this can be my entry, and then I can manage to have my take profit at the 1-1 risk reward ratio like this. This is a very simple strategy with a good risk reward ratio. So this is the second way, or let's say, so when you want to be a contrary trader, it means you want to trade against the trend. You see the losing momentum during the prior trend, and it means we have a downtrend and the market can't get lower than this support area here. It means selling pressures is waning, and then we can come against the trend, the prior trend, which is a downtrend, and find a buy opportunity in the market by taking a look at the bullish reversal candlesticks. Or we can come along with a trend in a direction of a prior trend when we see the, for example, downtrend hit the dynamic resistance or the resistance level. And this is the way that we can trade the candlesticks. You should practice it on the demo charts, and then please feel free to send me all of your charts if you found any something unclear or you had any question about that. I would be happy to be any of help there. Okay, we are almost done here. I think it's enough for today. If you have any question, please just write it down to me through the question tab. Okay, very good. Okay, it seems everything has been clear. Wish you a great weekend and thank you so much. Hope to see you in the next webinar. Thanks, bye-bye.